Dear all, myself CA Shashikala, welcome you all for and behalf of Team KSCAA to the day 4 and the final session of our series on Budget Amendments 2025, Assessments, Appeals and Penalties. Let us welcome today's session speaker CA Sumeet Khurana. He is a distinguished professional with numerous accomplishments. However, in his humility, he prefers a very brief introduction. Rather than highlighting his many achievements, he chooses to let his work speak for itself. As requested, I'll now present his introduction very briefly. Sumit Khurana is a chartered accountant and a law graduate with nearly 2 decades of experience in tax litigation and advisory. He has successfully assisted numerous clients in navigating complex tax disputes and developing proactive strategies to mitigate future risk. A warm welcome to you, sir, and on behalf of KCA and all the participants, very much thankful to you. And over to you, sir. And I request all the participants to post your questions in the Q&A box only. Over to you, sir.
Thank you, Shashikala ji, and thank you, KSCA, for having me here. A very good evening to all, and let's see what the this provisions which are given to me for kind of giving my thoughts on what it holds for all of us. So today I intend to cover these topics broadly without spending too much time on this. Probably we can strictly go to the first issue. So, many of you might have noticed that there is a change in time limitation computation. Various provisions in statute provide for an extension of time limitation for completing the relevant task, maybe assessment proceeding or something else. If any court has granted a stay or injunction, so the time consumed in the stay process, the law always provided that that period should be excluded. Now that phrase has sought to be amended, improvised, and widened. So let's see what exactly it says. While there are a whole host of sections which have been amended qua the clause, broadly the things are similar in all these sections. So if you could see even the first row, first column, the 144 WBA, for example, earlier the provision said that how much period will be excluded for the purpose of computing time limitation is the period during which the proceeding of the approving panel, this is the context of car, so is stayed by an order or injunction of any court. If you see on the right side, the proposed provision says it defines the period to be excluded in more specific terms. It says the period commencing on the date on which stay of the proceedings of the approving panel was granted by an order or injunction of the court and ending on the day on which certified copy of the order vacating the stay was received. So earlier we had a very brief description that period of stay shall be excluded. Now it says period commencing for granting the stay till the time certified order of the copy vacating the stay is received. So we'll just see why this controversy arose because it's very important because as you may know that the success in a case in a litigation proceeding in a very significant number of cases does not really depend on the merits of the case, the allowability of deduction or exemption or the taxability of income, but sometimes you're able to succeed in the proceedings on these technicalities like jurisdiction, time limitation, authority, etc. So I'll not run past through all these sections because fundamentally the amendments in all these sections are the same. We can proceed to how this thing has evolved. So what happened very long time ago, the Honorable Supreme Court had an occasion to deal with as to whether the time period consumed in the stay proceedings should be excluded for computing limitation or not. Say, for example, you get one year for completing the assessment, and out of that 1 year, 3 months have got consumed in the stay proceedings. Effectively, after the state proceedings are vacated, you should get 3 extra months to complete the assessment proceedings. That's the fundamental principle. So in this case, the situation was not exactly fitting into the provision for excluding the stay period. The court said that you don't read the clause very strictly. It is a very well settled principle that once a court grants a stay, that period has to be excluded for computing the limitation otherwise available in the law. Now, a connected point there is, which is also flowing from so many judgments in the second bullet here. Say, for example, you have to take an action pursuant an order. For example, you have to file an appeal or you have to file a rectification against an order. The law sometimes says that, say, 3 months, 6 months, 1 year from the date of the order, you have to take your action. You have to file your appeal within 3 months from the date of the order, for example. Even in such situations, what the courts have said that the expression date of the order used in the law should really be interpreted and understood to mean the date of communication of the same to the concerned party. So, if we apply this kind of principle in the context of our stay proceedings situation, the proposition that emerges is like that until unless the order of the court which vacates the stay gets to the knowledge of the concerned officer, how can he take further course of action of completing his proceedings? So, therefore, he should ideally be granted time right from the date of granting stay till the time he gets to know that the stay order has been vacated, and that happens only when he gets a copy of the order vacating the stay. And on similar lines, there are a whole host of judgments which said that the explanations in various sections which kind of permit the authorities to have an extended period of time limit by excluding this stay period, they are by way of abundant caution, meaning thereby that even in the absence of these provisions, the officers would have got an extra time for completing their proceedings by adding the time period of stay. But what has happened is, if you take a glance at the last bullet in this slide right now, some courts have held that no, the period starts from granting the stay, but it does not end by the time when the officer gets a copy of the court's order. The day the court announces that stay is vacated, that's the time the stay period really ends, and only up to that period can be extra provided to the officer for completing his proceedings. Now, because of these judgments were creating a lot of difficulty because of the time which the officer takes in getting the copy, that was getting missed out and he was getting lesser time to complete the proceedings. Therefore, the finance bill now proposes to say that now the time limitation available will be up to the date of getting the certified copy of the order. Now, what I want to bring out to you in this situation is, one, it is an important element of computing time limitation. We should be careful in our all pending ongoing proceedings before any appellate authority, revisionary authority, etc., to see that whether we can apply the strict interpretation applied by the courts in the last bullet here now, and try to say that the proceedings have already become time barred, with a caution that this proposition, even though the amendment is applicable prospectively, and we can still probably use the old understanding for the past cases, but with a caution, as I said, that with due respect, these judgments which have applied a very stricter interpretation to the explanations may not really hold the field, and that may not be your trump card to definitely give you a comfort that you'll succeed in the matter. But yes, there is an extra option available to argue in one extra point, with a caution that don't treat it as a trump card, but use it as one further potential argument to win the matter. Proceeding to next amendment in section 139 subsection 8a, we know this provision for few years from now, this provision essentially provides for filing an updated return. Whether or not already a return originally has been furnished within time, belated, or revised. So far, we had 24 months from the end of the relevant assessment year to file an updated return. Of course, subject to certain exceptions, that it should not be a loss return, it should not reduce your tax liability, it should not increase the refund, etc. And there have been certain other caveats that it should not be a case of search, survey, or things like that. And your already an updated return for that assessment should not have been filed, or the some proceedings, etc., should not be pending, or assessment should not have already been concluded. So those kind of cases, barring those, we get this opportunity of filing an updated return. So all these things fundamentally remain the same. As I said, the major changes, one major change is now we get effectively 4 years, 48 months from the end of the relevant assessment year, with one more extra caveat that if a show cause notice under section 148A in relation to reassessment proceedings has been issued after 36 months from the end of the assessment year, then this opportunity for updated return will not be available. Now, the reason seems to be quite simple. The updated return opportunity is for self compliant taxpayers. Once a notice, show cause notice under section 148A, qua reassessment proceedings are served, it is viewed by the lawmaker not to be a suo motu compliance, but a compliance triggered by and potentially adverse action by the tax department in relation to reassessment. So that kind of a case has been now carved out from the potential possibility of filing an updated return. They also say that even though show cause notice has been issued, but if after that notice an order has been passed giving a clean chit that okay, your case is not worth going for a reassessment, because after the show cause notice, considering the replies furnished, if the officers feel satisfied that the case is not worth issuing a notice under section 148, in that case the window opens again. You can file an updated return. Well, sounds good, but the question is, once you got a clean chit from the department that no reassessment should be initiated, then probably any taxpayer would think that now I'm out of the danger zone. Why should I now file an updated return? Well, there could be some situations wherein the 148A notice was issued qua transaction X, which you satisfied the officer that that's not worth warranting a reassessment proceeding. The officer satisfied and dropped it. But there could also be a potential transaction Y, which you believe that it could be a risk factor for me. So probably that kind of a case, that reopening of this window after dropping reassessment proceedings could be useful a window. Now this is broadly what we have already touched upon so far. So I don't feel like repeating it once again here. It's just the recapitulation of what we have so far talked about. Let's take a look at how it kind of pans out in a practically real life scenario. We put out say 3 assessment years, but sufficient to focus on only on the first practical column of assessment year, which is assessment year 22-23. Now see, for 22-23, if we opt for filing an updated return within 12 months time, already the loss is up to 25%. You can pay tax, additional tax of 25% of the tax involved plus the interest. So additional tax of 25% you can pay. Now this window for 22-23 has already lapsed as of today. The 24 months window, which requires you to pay 50% additional tax of the quantum of tax plus interest, that window is going to close by March 25. Now this new law gives you say okay 36 months window up to March 26 with an additional tax payment of 60%. And 4 years from the assessment year 22-23 will end on March 27, and that window gives you an obligation to pay 70% additional tax to avail this. Now, if you take, now we have so far talked about assessment year 22-23 onwards. So that's the broad scenario what will pan out to be. If you take an immediately preceding year, which is assessment year 21-22, take a case of assessment year 21-22. If we see 12 months period, March 23 already expired. 24 months, 2 years from assessment 21-22 expires on March 24. That's already all over. Now, this new law gives you 36 months period also. That is expiring on March 25. Now, the challenge is while the new law is giving an option of 36 months, at least for this year, they by the time on 1st April 25, by the time that new law will come into existence by 1st April 25, just the day before that, 36 months window will already be over. I wish that the lawmakers probably could have provided for an extra 1 or 2 months period for this cusp year, because the for this year the people will not be able to use this 36 months window, and by default the 48 months window will only apply, and one would have to pay 70% of additional tax. Now, even in this case, even if a show cause notice is issued under section 148A either by 15th March or another alternative scenario by 31st March, there is no possibility for the taxpayer to gain mileage of the new provision. If the show cause notice under section 148A is issued on or after 1st April 25 and that show cause notice is dropped, then he will have time limitation up to 31st March 26 to opt for the last fourth year window. And the same will be the case even if this show cause notice is not issued. So far as AY 21-22 is concerned, whatever permutation combination you can think of, ultimately that can only fall in the fourth year window, irrespective of any show cause notice under 148A issued or not. But yes, if the 148A show cause notice is issued and not dropped, of course, then the window is not at all there. Now, I was just thinking as to this elongated 36 months or 48 months, the 4 year window, how much practically useful it is for a taxpayer, and what kind of situations could possibly be there in which some taxpayer may want to make use of it. Take a case, hypothetical case, because it involves a huge amount of 70% of the tax and interest otherwise applicable to be an additional tax to be paid. Say somebody for assessment of 21-22 has is considering to file an updated return. We have evaluated two scenarios. One, the taxpayer files an updated return. Second, where he doesn't file the updated return but caught by the department under section 148 proceedings, reassessment proceedings. So, say a case where updated return is filed by say 31st January 26. So, for AY 21-22, this is the fourth year running. Now, in his case, we just hypothetically computed the relevant tax amount, the interest that could apply for uh, this thing, and total tax interest roughly comes out to be say 69 lakhs, 70 lakhs for 1 crore of income. In addition to that, the taxpayer will have to shell out some 48 lakhs of additional tax, and the total outflow will be more than the income he's going to offer. In comparison to that, if the taxpayer does not file the return and the reassessment order is passed by as late as 31st March 2028, the tax liability remains the same and interest amount definitely increases, and with the increased interest also, the total liability is roughly 88 lakhs. or 89 lakhs in this case, which is still a smaller number as compared to paying the tax plus additional tax. Now, this kind of example, if you take, whether the question therefore rises is whether a taxpayer will really be interested in kind of adopting this updated return option. Of course, I'm not suggesting that if one should not be compliant. Of course, one should be compliant because there are other penal consequences. Prosecution can also be there. But in cases where the concerned item of expenditure or income, which potentially can result into a higher tax outflow or higher total income computation, is a pure legal issue. Somebody might have otherwise wanted to be very compliant and file an updated return. Say, for example, you had been claiming the ESIPF deduction based on the legal understanding prevailing prior to the judgment of Supreme Court, the checkmate, or you must be claiming a deduction of any foreign remittances expenditure by not applying TDS, or by applying a different rate of TDS based on the most favored nation clause, and taking a treaty benefit of another treaty by intermingling two treaties by applying most favored nation clause, and post the Supreme Court ruling that MFN benefit is no longer there, and therefore there is an potential increased taxable income. In those kind of situations, probably it may be possible to defend the penal consequence and the prosecution. So in those kind of cases, probably the only outflow will be of tax and interest. So in such case of such scenarios, this kind of window will not be lucrative enough for the taxpayer, I believe, to go for a suo motu compliance. And therefore, I believe that it is important that from chambers and other associations, representations are made to relook at the proposed changes, so they're more they really entice and reduce taxpayers to be much more compliant. Now, another very important change is there in the penalty section, section 275. As I said, you know, more than the merits sometimes, because it happens that merits are difficult, sensitive, and ultimately you may have to fall back on things like jurisdictional defect or time limitation. So this section again becomes important because section 275 provides for time limit within which a penalty order has to be passed. So there is some rationalization or change or some provision in the section. The section has been totally substituted, and from 1st April 25, the new section will operate. I will quickly touch upon what the provision says, uh, slightly compare it with the existing provision, then we'll get to some illustrations as to how this will apply, how will it change the situation vis-a-vis old law, new law, and can there be some situations where taxpayer can really benefit from this change. We'll see those illustrations in few minutes from now. But before we really talk about illustrations, let's take a close look at what the section really says so that we can better understand those illustrations. Now, this section says that no penalty order can be passed after a period of 6 months from the end of quarter in which relevant things have happened. For example, first thing is there is a proceeding, say assessment proceeding, during which penalty proceedings are initiated. So there is assessment proceeding during which a penalty proceeding initiated. That assessment proceeding, when it is completed, from completion from the quarter in which it's completed, from the end of that quarter, 6 months are available for passing penalty order. So say assessment completed in November. That quarter is October, November, December. So 6 months from December, which means up till June next year, there's a time to pass penalty order. Likewise, clause B, if there is a assessment, so first clause is case of assessment which has not been subjected to, which has not been appealed against. Clause B is a case when the assessment has been revised under section 263 or 264 by commissioner exercising revisionary power. So the quarter in which the 263 order is passed, 6 months from that quarter is the time limit for passing penalty order. Likewise, if an appellate order has been passed under section 246 or 246A, then again from the 6 months from the end of the quarter in which that order is passed. So without getting into each and every clause, we just quickly touch upon subsection 2 of section 275 now provides change in the quantum of penalty depending upon whether penalty order itself has undergone some appeal or revision, and subsection 3 provides time limitation of that. And subsection 5 provides for time limitation, which similarly if the proceeding have been stayed, that will be further added to the available time, and time limit during which section 129 rehearing has happened. We can just leave it at there. Let's take a look at it how it will pan out, especially focusing first on the order passed pursuant to an appellate order by the CITA or GCIT. Earlier the law was the penalty order should be by the end of the financial year in which the proceedings, assessment proceedings, which resulted into penalty, they are initiated, or 1 year from the end of the financial year in which the appellate order is received by Principal Commissioner CIT. Larger of these two limitations will be the limitation available for uh, passing the penalty order. So most of the times you will find that 1 year from the end of the financial year in which the appellate order is received will be the larger limitation. So we have based our illustration based on that. Now the proposed law says the penalty order should be, as we just now read, 6 months from the end of the quarter in which the order of appeal is received. Now we will take an illustration. Say the CITA order is dated 1st October 24 and it is received by the principal commissioner within the same month. Now, under the erstwhile law, if you see the clause B here above, we have to see 1 year from the end of the financial year. The financial year here applicable is 24-25 because October 24 is the date of receipt of the order of commission appeal. So that being the date, October 24, the relevant financial year becomes 24-25, and you get 1 year time from there, which is 31st March 26 is the time available for passing penalty order pursuant to revised assessment pursuant to CITA's order. If you apply the new law, it says 6 months from the end of the quarter. So now if you see October 24 means quarter is October, November, December, that quarter. 6 months from there will end on 30th June 25. As per erstwhile law, he had time up to March 26. The moment new law, this one 275, new 275 comes into existence, it will come to existence practically on 1st April 25. 1st April 25 comes into existence, just immediately the time period available for passing penalty orders cut short from 31st March 26 to 30th June 25. See, that's how the change, because every time, every year we get into these kind of computations, calculations. The moment any procedural provision is amended, a time limitation is amended, it has a significant impact on the entire chain of assessment appellate proceedings. If you see, because of this, there will be suddenly an urgency to pass penalty orders soon after the Finance Act comes into existence. Once the bill is enacted into Finance Act, he'll have just practically 3 months window, while otherwise he would have practically 1 full year for passing penalty order. and any slippage therein, you can use it to your advantage, telling the authorities, thank you very much. Now the procedure time bar. You can't pass any penalty order now. Take another example, just to understand these provisions slightly more, deeply. If the commissioner appeal order is dated 1st July and received by PCIT within the same month, we need to talk about this because erstwhile law, the time limitation factors when it is received by the PCIT or CIT. Now, financial year, it is received, it is the CIT order is July 24, financial year again 24-25. 1 year from that, same 31st March 26. As per new provision, the quarter is July, August, September, September quarter, and 6 months from there will be March 25. So, see, 1st April, the new law comes into existence, and as per new law, it has already got time bar. As per old law, the authority had time up to one more next year. But just because new law comes into existence, it says already become time barred. See, this is all similar thing to what we saw in what happened in the reassessment, big bunch of cases of Ashish Agrawal and later Tola judgment of Rajiv Bansal. This is very significant, very important. We have to pay very close attention to how in your particular case time limitation will apply. If you ask me technically, honestly, I personally believe, and my belief is not based on some whims and fancies, based on judgments of Supreme Court in this context, this similar context. So there are two connected propositions. It is undoubted that the moment new law comes into existence, the the limitation provided under the new law governs the field for any pending, ongoing, or yet to be started proceedings. That's the proposition. Slight exception to that is this kind of an extreme case where if on the date of existence, on the date of coming into existence of new law providing shorter limitation, because of which the proceedings have already become time barred, this extreme kind of a case, then some reasonable period can be made available to the officers to complete the proceedings. But fortunately, from department side, these kind of arguments and judgments are not quoted, and taxpayers tend to benefit from there. So do take these kind of arguments, try to succeed on technicalities as well as merits is the reason why I'm bringing it to you. Now, similar to what we have discussed in case of an order of tribunal, again, the provision earlier was from end of the financial year in which the relevant proceedings are completed, and now again it becomes 6 months from the end of the quarter. I'm not going to burden with you with the details, nuances of different kind of permutation combinations. I think as and when we have that relevant proceedings, we can go back to the section, read the relevant clause, and apply it accordingly. Fundamentally, how it will pan out, we have seen in the illustrations uh, just now. Yet, we'll just take some illustration here to understand it, the practical applicability of that. Take a case where an order by the tribunal or revisionary order under section 264 is dated 1st October 24 and received by the PCIT CIT in the same month. The relevant month being October, under the existing provision, it provides 6 months from there, which ended on which is about to end on 30th April 25. The new provision substitutes to say that it is 6 months from the relevant quarter ending. So in this kind of a I know when we are talking about the order of the tribunal or 264, the clauses are different. When we apply these clauses to the relevant situation, the officer will get 2 months extra here. Similarly, just one more example. Effectively, there can be situations where the officer gets extra time. There can be a situation where the time gets curtailed. So effectively, we need to apply the relevant clause into the applicable situation and come at our conclusion. But yes, one very interesting situation I would like to deal with here and share it with you. At the bottom of the slide, if you can see, say there's an order under section 263 passed on 1st October 24. The question is, by what time the consequential proceedings of the assessment and penalty can be passed? So far, we have seen penalty when can be passed vis-a-vis old law and new law. Let's now take a case where penalty as well as consequential assessment order, how these two timelines play with each other. Say if 263 is passed on 1st October 24, take a case of new law only now. See, time limit to pass penalty order, we have seen that it is 6 months from the end of the relevant quarter. Quarter is your October, November, December. 6 months from there comes to 30th June 25. So there is an order of section 263 revisionary order asking the officer, telling the officer that you have not looked into ABCD things, please reframe the assessment. Consequent to this, when he passes penalty order, for the time limit is given 6 months from the end of the relevant quarter, in which the revisionary order is passed, which lapses on 30th June 25. But if it's time limit for de novo assessment under section 153, it says 12 months from the end of the financial year in which the revisionary order is passed. So the financial year in which revisionary order is passed here is 24-25, and 12 months from there is 31st March 26. So this gives us a very unique and kind of situation where for passing as an assessment he has time limit up to March 26, but for passing penalty order he has time limit only up to June 25. So either the officer will be compelled practically to even conclude assessment by June 25, and if he fails to do so within that time frame, he'll be able to pass an assessment, but he will be unable to pass a penalty order because time limit for penalty order would have already expired. So it's very important to pay therefore attention to these time limitations. There can be situations like this. Shashikala ji, do we take any Q&A now because lot have been talked about, and or should we do it at the end only? There may be.
Anything is fine, sir. It's according to your wish. If participants have any question, they can post it here. I'll note down and I'll read it out for you at the end also.
And okay, so ठीक है. So I'll just quickly finish this 72A because I think that's one of the main things I want to touch here again. The other things maybe somewhat a repetition from other session. I'll finish this 72A. We will wait for any Q&A by that time and then take the rest of the discussion.
Yes, sir, sure.
This section 72A talks about giving, if I can say, kind of uh, grandfathering the losses. Company A amalgamates with Company B. Company A had incurred losses. When it amalgamates with Company B, from the year of amalgamation, 8 years will be available for further carry forward and set off of those losses, the business losses and depreciation. Company A must, Company A when it incurred losses, it might already be in the seventh year of using those losses. The losses are still unutilized. In the seventh year, when it amalgamates, the fresh lease of life of 8 years commences for carrying forward and set off those losses. Now, this regime and scheme and provision started getting used, oblique misused by corporates by repetitively carrying out amalgamations within the group companies and having yet another 8-year time limitation to utilize the losses, and therefore the losses became evergreen. To curb that practice, now the law says that any amalgamation which is effected on or after 1st April 25, any amalgamation which is effective on or after 1st April 5, the loss, how we would see is the period you will see from the first predecessor entity. The original predecessor entity was the inspector first amalgamation. From there, you see only 8 years. That is the maximum time frame within which you have to set off your losses. So the repetitive amalgamations will not give you every time a fresh extension of 8 years, is what this clause effectively says now. Similar provision introduced in 72AA for banking and other companies like this, government companies. Now, if you apply this in practice, how it will pan out to be? So one question which arises here is, when the new provision this says that any amalgamation effected on or after 1st April 25, what is this meaning of this word effected or effective? Is it appointed date, or is it the date by when the ROC gives effect to the order of the court? Now, in this, if we look at how the Companies Act deals with it, how the judgment of Supreme Court in the case of Marshall and Sons dealt with this thing, it seems quite reasonable to conclude that when the section now says effective date, it is the appointed date only. And appointed date is when the scheme, amalgamation scheme prescribes that this amalgamation, is will be effective from this appointed date. That's the date we have to see, and if that date is falling on or after 1st April 25, and that is when this new provision will impact the structuring. Now take a look at, I'll just take one illustration and it will show the kind of unintended harsh impact of this provision, I believe. Because it now says that you have to go back to the loss first computed for the original predecessor entity, the first amalgamation. Take a illustration. Say ABC Limited amalgamated with I'm sorry, ABC Limited amalgamated with say XYZ Limited, say on 1st April 2014, and it now becomes entitled for next 8 years carrying forward in the hands of XYZ Limited, which becomes say assessment 23-24 up to 23-24, it can carry because of this amalgamation. The losses incurred by ABC Limited can now be carried forward by XYZ Limited for 8 years from the year of amalgamation. That comes out to AY 23-24. In between that, just before that, the 8 years have still not expired. XYZ amalgamates with Y Limited, and appointed date is 1st April 22. Because of this, you'll get one more 8 years of life, which could go up to assessment at 31-32. Now, this amalgamation has happened 1st April 22, and it is giving time for carry forward of losses, say assessment 31-32. Even if there is some inaccuracy in these dates, please excuse that. Let's focus on the fundamental that potentially this Y Limited has a right to carry forward a set of losses up to say assessment 31-32, and in between on 1st April new law comes into existence. Any impact on this structure? No, because amalgamation has already happened in past. There is no amalgamation happening on or after 1st April 25. New law has no impact on this. And believe and assume that all these amalgamations are only carried out for the tax purpose of carrying forward the losses. Assume that. And assume now, because of some commercial reason, Y Limited has to amalgamate with Z Limited on or after 1st April 25. Because it already has a lot of time period to set off losses, And probably this amalgamation, we can assume, is not for the tax benefit but for the commercial purpose. Now, because the amalgamation is happening on 1st April 25 onwards, the new law comes into application and says, for any carry forward set of losses, please go back to original entity, which is ABC Limited, that could have carried forward the amalgamation. First amalgamation happened in 14, and that could have carried forward losses up to 23, 24. So no loss can be carried forward set off with the effect from 1st April 25. So otherwise a loss was available up to say 20, 31, 32. Because of one more amalgamation, that gets blocked and denied. This may not be the intended consequence. Probably they should have said that the new amalgamation will not further increase the time available. But because they're just taking the clock back to the first amalgamation, it is resulting into a harsh consequence like this, which probably I believe must not have been intended to be applied in such cases. And if I believe somebody gets into this kind of situation where for commercial reasons one has to amalgamate, then probably a reverse merger could be one option rather than Y amalgamating with Z and losing its existence. Let Z amalgamate with Y if possible under subject to other consequences, so that the losses which the Y would have otherwise been able to carry remains intact. That's mainly what I wanted to cover for today. I believe this issue of Section 92 CA, the transfer pricing related assessment and consequential proceedings, might have been touched upon in some preceding session. I can take a pause here. If there are any questions from any of the my esteemed audience, we can take it up now. Or if there is nothing, maybe we can proceed to cover this up also. Looks like the one good number of days have already elapsed. People have seen the same thing or heard the same thing from multiple sources. So nothing more to probably talk about. Then I'll just quickly resume my deliberation on the last practical element of the transfer pricing assessments. Something very interesting has been brought out with the intent to facilitate smooth assessments and avoid repetitive deliberation on the same kind of transaction year on year, and provide that one time we'll fix the arm's length price, at least it will be applicable for next 2 years. And to the extent I know, every concerned tax professional is struggling to decode it. With due respect, it seems that the section has been crafted the way it requires some more tweaking so that it becomes more easily understandable and more meaningful. So very quickly, what is as I said, what is suppose now the provided is that during the course of transfer pricing assessment, when the arm's length price is being determined, that's the phrase used, the taxpayer can opt for a proposition that this year's arm's length price will apply for next 2 years also. And how it will pan out is, maybe I can, instead of taking through the text of the law, the way it provides is, during the course of proceedings, the taxpayer can opt for that this year's arm's length price may be for one transaction, maybe for all transactions, maybe some of the international transactions can be validly applied for subsequent 2 years also. And for this, the taxpayer would have to file a form, and form will be prescribed by rules which are yet to be announced. And uh, and once that happens, the transfer pricing officer would then deliberate on and see whether it is agreeable to him, and pass an order within 1 month from the month in which the taxpayer has exercised his option, and give his acceptance or otherwise that yes, I am agreeable that this year's arm's length price will be applicable for next 2 years also. Some of the questions are like this: that can the taxpayer, after having chosen or selected this option, can opt out for this, or can select it only for one of the two later consecutive years, or how it will pan out? As of now, it seems that having made once this election, the law does not provide for opting out of it, and probably the taxpayer and both the department would be bound by this option once concluded. So year 2 and 3, therefore, what will happen is this subsection 4A, which is also now introduced, provides that the transfer pricing officer will determine the arm's length price for the next 2 years. But this determination, as we could probably understand, is not a fresh determination, but whatever the arm's length margin, etc., was determined in the year 1 would be applied in the year 2 and 3 transactions to ascertain the ultimate quantum of addition or otherwise. So timelines wise, for year 1, it will be the assessment will be first finished within the normal timeline prescribed in section 153, and in year 2 and year 3, initially it may be as per original 153 section 153 timelines, but year 2 and year 3 will thereafter be subjected to yet another change, probably depends on the situation, as I said, because by the time year 1 achieves any finality, year 2 proceedings might have already been completed or pending. If it has already been completed, section 155 provides that concluded assessment should be recomputed in conformity with the year 1's final arm's length price. And if it is not concluded, it can still be concluded, and after its conclusion, 3 months yet be given to the department for revisiting, recomputing that year 2 year 3 assessment to bring it in conformity with year 1's transfer pricing arm's length. So the way it is structured, it appears that even if the subsequent year there is no assessment, it's only 143 one summary assessment, whatever you filed has been accepted. By virtue of section 155 subclass 21, which is proposed to be introduced, that can be revisited to apply the uh, effect of section 92 CA subsection 4A arm's length price, which the TPO will now compute having regard to year 1's determination. Now, it may so happen that in year 2 and year 3, there is no separate uh, transfer pricing reference, which could be two reasons. One, because in year 1, already an kind of agreement has been reached between the taxpayer and the tax department that this year 1's arm's length price will only be applicable for year 2 and year 3. Law says for that very transaction for which you have made such an option agreement, for the same transaction, there will not be even reference to TPO. The reference to TPO can be for some different transaction which has not been opted for under 92 CA. Barring that case, if there is no TP reference, then the time limit for completion of the assessment will be governed by basic 153 time limitation, and an extended 12 months period, which is typically available in a TP reference case, will not be available for the year 2 or year 3 if a separate TP reference in that case is not otherwise sustainable. The proposed law also goes ahead to the extent of saying that if, despite an agreement in year 1, by mistake, say a reference to TPO has been made, it will be treated as if no reference was made. Therefore, it will still fall back on the time limitation of 12 months as per section 153(1), and extended time limitation of additional 12 months for TP reference assessment will not be available. So there are certain nuances in this. We can probably take this last illustration to understand the mechanics how this provision can probably work out. Though I believe that by the time of enactment, this provision will go under substantial changes, because the way it is worded is, it is leading to some ambiguities, which I think we probably need not deliberate as of now, because once the section gets modified, probably we will be in a better position to evaluate. And if it is enacted in the current shape, then also it will be a better occasion to do the dissection of the section in a more exhaustive manner. But be it as it may, for the timing, if we see assessment year 26-27, assume it is the first year, and 143 to notice, if you focus on the first column practically, the 143 notice should happen by 30th June, and 153 one time limitation, assuming there is no TP reference, would happen by 31st March 28. But a reference to TPO, if made by at that date, will extend the total time limit for assessment by 31st March 29. The transfer pricing of it order by a backward calculation, because that's how the law provides, that it has to give some 60 days to the assessing officer. So therefore, the transfer pricing order should come by 28th January 29. And again, because the assessee has to make an option and give TPO 1 month at least to decide whether his option to be is acceptable to TPO or not. If we do yet another backward calculation, then the taxpayer would have to probably give his option on or before 30th November, though it is yet subject to maybe whatever rules will come out. But that's probably the ultimate date beyond which it may not be possible for any taxpayer to exercise this kind of an option. And transfer pricing officer will pass an order accepting rejecting this within 1 month from the month in which he exercised the taxpayer exercises option, which is say practically in this is this case scenario 31st December 28. And because now interestingly, the section 155 clause 21 envisages that this year one might undergo DRP proceedings. Now it's a little difficult to fathom as to when a TP arm's length price has been accepted both by SSC and department. Why should there be a case for go to DRP? But yet it can be situations where there are corporate tax additions also, and for that corporate tax additions, the taxpayer is knocking the door of DRP. In which case, tentatively, the DRP direction could come by 31st December 29, and the final assessment order could get passed by as late as 28th February 30. Now, if you take that date, 28th February 30, if you see the next 2 years, there is, assuming there is no other international transaction, there is no TP reference. So the time limit for passing the basic assessment would be over by 31st March 29 in this case. And section 155 says that the even though it has been concluded, this second year's assessment, though concluded by 31st March 29, can be revisited within 3 months from the date by which the final assessment order of year one is passed. So year one final assessment order passed by 20th February, 3 months will be available for revisiting year two or year three. So 3 months from there, from 28th February, now the yet another complication, whether 3 months from 28th February would end on 28th May or 31st May, yet another controversy, because there are judgments which define as to how you have to calculate the period from a particular date. So if you have to calculate from this date, there could be two possibilities. The officer has got 28th May time limitation available or 31st May. Subject to that, the controversy, he should complete year two by either of these two dates. And similarly, for the third year, the otherwise time limitation was March 30. Now he can get also, the provision also says the 3 months from the date of completion of this assessment can be time limitation available for revisiting this. So for a case, this kind of case, he can pass up to June 30. That's the outer time limit provided in cases where by the time of first year final order, your third year original order is not yet passed, it is yet to be passed. In such cases, we get 3 months from the time on which the assessment is first framed in year 2 or 3. So that takes up to us that takes us to up to 30th June 2030. So just to explain the mechanics as to how the time limits will play out, and though there are other nuances of how to this how this subclause 4A will work and how this 150 or 21 will work. But since there are too many opponents there, I think I'll just keep it this discussion up to this point only. Thank you very much again for having me here, and probably if there is something by now, we can take it up. I believe nothing more is there.
There is no more questions. Yes, sir.
No, no. Thank you so much for having me here. It's a pleasure being here.
Yes, sir. Thank you so much, sir, for accepting our invitation and having the session here, which was a very crispy and much needed update on the budget, more specifically to the period of limitation, actually. I thank you for, on behalf of KSCA, for accepting our invitation and making this a grand success. I also thank our president, CA Vijaykumar and Patel, and also the chairman of our direct tax committee, CA Deepak Chopra, and DT committee members for organizing this program, and also the participants for making this program. Thank you all once again. Have a great weekend.